Hello, and welcome to this educational video on fractional reserve banking. In this video, we will delve into the details of how fractional reserve banking works, the pros and cons of the system, and how it affects the economy. What is fractional reserve banking? Fractional reserve banking is a banking system where banks keep only a fraction of the deposits made by their customers as reserves and lend out the rest of the money to other borrowers. The reserve requirement is set by the central bank, which is the institution that oversees the banking system. For example, if the reserve requirement is set at 10%, then a bank that receives a deposit of $100 from a customer will keep $10 as reserves and lend out the remaining $90 to other borrowers. Let's take a closer look at how fractional reserve banking works. When a customer deposits money into a bank, the bank keeps a fraction of that deposit as reserves and lends out the rest to other borrowers. The money that is lent out to borrowers is then deposited into other banks, and those banks, in turn, keep a fraction of that deposit as reserves and lend out the rest to other borrowers. This process repeats itself, and the amount of money in circulation increases as more and more loans are made. This process of creating money out of thin air is called the money multiplier effect. The money multiplier effect is the amount by which the money supply is increased for each dollar increase in reserves. The money multiplier effect is calculated by dividing the total money supply by the amount of reserves held by banks. For example, if the reserve requirement is set at 10% and a bank receives a deposit of $100, the bank can lend out $90. If that $90 is deposited into another bank, that bank can lend out $81, 90% of $90, and so on. The total amount of money that can be created in this process is calculated by dividing the initial deposit by the reserve requirement. In this example, the total amount of money that can be created is $1,000. Fractional reserve banking and the economy. Fractional reserve banking has a significant impact on the economy. One of the benefits of fractional reserve banking is that it allows banks to create more money and increase the money supply, which can stimulate economic growth and promote investment. However, it also has some negative consequences. Firstly, fractional reserve banking can cause inflation. As more money is created, the value of each dollar decreases, leading to an increase in the price of goods and services. This can be particularly harmful to people on fixed incomes and those with limited financial resources. Secondly, fractional reserve banking can lead to financial instability and economic crises. If banks make too many bad loans or experience a sudden rush of withdrawals, they may not have enough reserves to cover their liabilities. This can lead to bank runs and even systemic failures that can ripple through the entire economy. Fractional reserve banking can also exacerbate wealth inequality. As banks create more money and lend it out, those who can access credit may benefit from increased access to financial resources, while those who cannot access credit may struggle to keep up. Pros and cons of fractional reserve banking. Like any other economic system, fractional reserve banking has its pros and cons. Let's take a look at them. 1. Increases the money supply. Fractional reserve banking allows banks to create money out of thin air, which increases the money supply in the economy. This can stimulate economic growth and promote investment. Provides liquidity. Fractional reserve banking provides liquidity to the economy by making it easier for people to access credit. This can help people start businesses, buy homes, and invest in education. 3. Lowers the cost of borrowing. Fractional reserve banking can lower the cost of borrowing by increasing competition among banks. This can make loans more affordable and accessible to more people. Fractional reserve banking is a risky system because it relies on banks to make good loans and manage their risks effectively. If banks make too many bad loans or experience a sudden rush of withdrawals, they may not have enough reserves to cover their liabilities. Fractional reserve banking can cause inflation by increasing the money supply faster than the production of goods and services. This can lead to a decrease in the value of money and an increase in the price of goods and services. Fractional reserve banking can lead to boom and bust cycles in the economy by making credit too easy to access during boom times and too difficult to access during bust times. This can lead to financial instability and economic crises. Fractional reserve banking is a system where banks keep only a fraction of the deposits made by their customers as reserves and lend out the rest of the money to other borrowers. While it can promote economic growth and provide liquidity, it also has some negative consequences such as inflation, financial instability, and wealth inequality. It is important for individuals to understand the workings of fractional reserve banking and for regulators to maintain proper oversight to ensure the stability of the banking system and the broader economy. Like, comment, subscribe, and thanks for watching.